All right, let's jump right into this explainer. Today, we're unpacking a mystery that practically haunts every quantitative trader and investor out there: algorithmic trading backtests. We are going to dig into some truly fascinating new research to figure out if those sky-high historical returns you see on paper are true, actionable signals, or if they're just statistical noise cleverly masquerading as a money-making machine.
To figure this out, we're breaking things down into 5 parts. First, the backtesting illusion. Then we'll meet the MinervaScore, walk through the 5 validation gates, run some synthetic data stress tests, and finally, do a real market reality check. Let's get to it.
Part 1. The backtesting illusion and the real danger of search luck.
You know, it is so incredibly tempting to look at a massive historical return. You know, that beautiful high Sharpe Ratio curve just climbing up and to the right, and think, bingo, I found a guaranteed winner. But we really have to pause and ask ourselves, is that result actually real? If an algorithm absolutely crushes it on past data, does that prove it's inherently smart, or does it just mean it got insanely lucky while we were searching for the right parameters?
Think about it like the lottery. Winning the lottery doesn't suddenly make you a financial genius, right? It just means you bought enough tickets. And honestly, the exact same principle applies when you're tuning algorithmic trading rules over historical data. If you test, say, 10,000 different combinations of moving averages and stop losses, and you only pay attention to the absolute best one, well, of course it's going to look amazing. It's literally just the maximum of 10,000 random draws.
Which brings us to a really fatal flaw in quantitative finance. We call it selection bias. See, standard metrics, like your basic Sharpe ratio or maximum drawdown, they completely ignore how many failed candidates you threw in the trash before finding that one winner. When a strong backtest is simply the top result of thousands of unseen trials, those standard metrics become, well, dangerously misleading. They're showing you the survivor, but they are completely hiding the graveyard.
All right, part 2. Meet the MinervaScore, our truth teller in all this.
So unlike those standard metrics that basically just show you a pretty equity curve and call it a day, this new MinervaScore acts as a post-search validation layer. It rigorously interrogates the data you've already selected. Instead of completely ignoring the trial count and the risk of overfitting, the MinervaScore acts as a post-selection robustness grade. It explicitly factors in the search effort, meaning how many lottery tickets you bought, plus how much history you actually have, and how well the strategy handles entirely different market regimes.
Now, here's the kicker about how this score actually works. It sits on a scale from 0 to 100, but getting a score of 80 or higher is mathematically locked behind what the researchers call a binary robustness seal, meaning a strategy can't just be pretty good on average to scrape an 80. No, it has to perfectly survive every single validation test we throw at it to cross that threshold. It is totally all or nothing if you want to reach that top tier.
Part 3. The 5 validation gates. Interrogating the data.
Okay, let's really unpack the architecture of the MinervaScore, because it's vital to see how these pieces flow together, both visually and mathematically. Look at those 5 distinct boxes up at the top. Those are our validation dates. First up, DSR. This asks, is the Sharpe ratio actually real? It requires a pass at 0.95 or higher, and notice it carries a really heavy weight of 0.35 pointing straight down. Next to it is PBO, which assesses out-of-sample survival. That one's capped at 0.50 and weighted at 0.25. Then we've got SPA, checking if it truly beats the benchmark, passing at 0.10 or less, weighted at 0.20. Fourth is MinTRL, basically demanding a statistically sufficient track record length. And finally, on the far right, the regime gate checks stability across different market conditions, passing at 0.60 or higher with a 0.10 weight. Now follow those arrows down to the equation at the bottom. This is where the magic happens. The system takes the margins from each of those 5 tests, basically measuring how far the strategy is from failing each individual gate, and elegantly combines them into one unified grade. It uses a weighted inverse normal blend. You can see the math there, calculating a final value where S equals the transposed weight vector W times the z-scores, all divided by the square root of W transpose times the covariance matrix sigma times W. I know, a bit of math, but essentially, this single transformation converts 5 very different statistical hurdles into one continuous raw probability score between 0 and 100. And remember that seal on the bottom left? That only lights up if all 5 of those top boxes clear their specific thresholds.
So,
Just to summarize this gauntlet we're running strategies through, each gate interrogates a totally different way a backtest can fail. DSR strictly penalizes you if you ran massive, sprawling search trials. PBO verifies the strategy doesn't just instantly collapse when it hits out of sample data. SBA checks if it actually outperforms the benchmark. MinTRL makes sure your backtest isn't dangerously, suspiciously short. And regime stability ensures you didn't just happen to run your test during an incredibly easy, one-directional bull market. If a strategy fails even one of these, boom, locked out of the top score tier.
Moving to part 4, synthetic data stress tests, finding the truth hidden in the noise.
All right, let's look at some lab-controlled synthetic data. This is super cool because here, researchers knew exactly which strategies had a genuine edge, those are the solid blue lines, and which were just pure lucky noise, the dashed gray lines. Focus closely on these 6 charts. Across all of them, the x-axis represents the number of optimization trials on a log scale, going from just a few dozen all the way up to thousands. Start with the top row. In the top left chart, watch what happens as the number of trials increases. The raw score for genuine strategies drops dramatically. Right next to it, the DSR margin chart plunges downward too. The system is actively penalizing that lottery ticket search effort we talked about earlier. The PBO margin on the top right drops a little bit, but stays relatively resilient, mostly because it's measuring out of sample consistency rather than just pure search size. Now jump down to the bottom row, which shows the z-scores for predictive ability, minimum track record, and regime stability. Notice how the z-spot chart fluctuates slightly but still clearly maintains a gap between true edge and noise. The MinTRL chart? That stays incredibly stable across trial counts, which makes sense. The size of your search doesn't actually change the length of your backtest. And across all 6 panels, I really want you to pay attention to those dashed gray lines representing pure noise. They behave exactly as they should. Because they have absolutely no true edge, their margins and scores just stay low and flat. They are entirely unaffected by how many times you run that random search.
The big takeaway here is actually pretty profound. More trials literally equals a greater statistical penalty. The score correctly assumes that if you pluck a winner from 5,000 attempts, it deserves way less statistical confidence than a winner you found after just 20 attempts. Even a strategy with a completely genuine edge will see its score take a hit if it's buried in a massive data dredging operation. Because, mathematically speaking, the risk that your winner was just outshone by a lucky noise candidate becomes very, very real.
Okay, now let's see what happens when we isolate the length of the history. In these 6 charts, the x-axis is changed. It's no longer the number of trials, it's the actual length of the backtest data, going from 252 bars up to 5,040 bars. Check out the top row again. You've got the raw score on the left and the DSR margin in the middle. Look at that solid dark blue line representing genuine edge. It shoots aggressively upward as the history length increases. It is being heavily rewarded for surviving more data. Now look at the bottom row. SPA, MinTRL, and regime stability. Across every single one of those metrics, the solid blue line slopes powerfully upward as the backtest extends toward that 5,040 bar mark. The longer a genuine edge survives, the higher its z-scores climb. But here's the most critical part. Look at the contrasting dotted gray line, the one representing pure noise, across all 6 of these panels. It stays completely, utterly flat. Literally, no matter how much data you feed into the pure noise strategy, its score does not budge in any category.
What this proves is that the core mechanics of the score are working flawlessly in the lab. If you give more historical data to a genuine strategy, it heavily boosts its grade, right? Because true statistical evidence is physically accumulating. But, and this is huge, giving more historical data to a pure noise strategy doesn't suddenly make it look more convincing. Thanks to a properly calibrated no benchmark, noise stays recognized as exactly what it is: noise forever.
Finally, Part 5. Real Market Reality Check, the Ultimate Verdict.
So it works in the lab, but this reliability diagram offers a fascinating piece of transparency from the researchers when dealing with reality. On the x-axis, we have the mean MinervaScore in a given bin, and on the y-axis, we have the empirical, actual rate of true edge. Now see that dashed gray line running diagonally straight across the middle? That represents perfect probability calibration. Basically, if the score said 40%, the actual edge rate would be exactly 40%. But observe the solid blue line representing the MinervaScore. Notice how it shoots up much faster than the diagonal line and then kind of flattens out near the top? That divergence is quantified by the expected calibration error, or ECE, of 0.17. That number visually represents the average gap between our solid blue line and that perfectly calibrated dashed line. So, what does this actually tell us? It illustrates that the score correctly and monotonically ranks strategies, like a higher score absolutely guarantees a higher chance of having an edge, but it is not perfectly calibrated as a pure, raw probability percentage of future success.
And look, we have to remain completely objective here, which is honestly why this research is so refreshing. The MinervaScore is an incredible ranking tool. It is phenomenal at filtering out statistical noise and figuring out which strategies actually have the most robust evidence backing them up. But, as the researchers themselves very clearly state, it is not a magic crystal ball. It is not some perfectly calibrated probability metric that guarantees you future wealth.
In fact, when they took this out into the wild and ran pre-registered real-world tests on the S&P 500 and Mid-Cap 400, the results were incredibly sobering. Let's look at the numbers. Starting from the top, out of 352 enrolled strategies evaluated on totally unseen data, the median out-of-sample Sharpe ratio was a negative 0.15, meaning most of these strategies just flat-out failed. Moving down, because this specific market population was practically totally devoid of any true edge, the MinervaScore rightly refused to manufacture a signal where none existed. The result, a Spearman correlation of just 0.013, leading to completely null forward predictability. It didn't predict success simply because there was no success to predict.
The authors are incredibly intellectually honest about this. Just look at this quote directly from the paper. We present the MinervaScore as an auditable validation and reporting layer rather than as evidence of demonstrated real market predictability. They are framing this entire system as an essential, strictly auditable BS detector. It's designed to prevent you from deploying dangerous overfit garbage. It is absolutely not a guarantee of future profits.
Which leaves us with one critical, pretty provocative thought to take away for your own research and investing. If your highly optimized, totally dialed in algorithmic trading strategy cannot survive these 5 mathematical gates, if it can't even survive the statistical penalty of its own search history, are you actually trading on true edge? Or are you just trading on luck, simply waiting for the illusion to shatter? Definitely something to think deeply about before you deploy your hard-earned capital. Thanks so much for joining me on this explainer, and I'll catch you next time.